Hi traders, in this particular video we are going to be talking about the relative strength index. We are going to identify how to use the relative strength index. In this particular video we use it to identify we're going to explain how to use the RSI to identify overbought and oversold levels in the market, or oversold and overbought conditions in the market. And we're also going to use the RSI to identify the strength of a trend and potential reversal points, and also how to spot divergences using the RSI. So let's just get right into it. The RSI is a momentum indicator, like it's one of the most popular momentum oscillators in the market, and it helps traders to identify overbought and oversold levels in the conditions in the market. And many traders use the RSI in their trading strategy. Now, how do you understand the RSI? Let us first of all identify the RSI levels. So as we can see, the RSI ranges from 0 to 100, from the 0 level to the 100 level. An RSI level above 70 typically indicates that an asset is overbought, suggesting a potential price correction. So these periods when the RSI was above the 70 mark, it indicated that the price of the asset were possibly preparing to reverse their bullish move. On the other hand, an RSI below the 30 indicates that an asset is oversold, and it suggests that there could be a potential price increase. Now, the neutral zone varies between 30 to 70, as we can see here, and it indicates a neutral market where there is no clear overbought or oversold conditions. Now, how do you read the RSI levels? As we already mentioned, the overbought level is from 70 and above 70. When the RSI crosses above the 70, it may signal that the asset is overbought. Now, traders often look for selling opportunities around the zone or take their profits in the zone. For example, we can see that while the RSI was above the 70 level and indicating an overbought signal, as the price dropped below the 70, we can see that the price of the asset responded accordingly. So we could have considered entering the sell trade right as the RSI line began to dip from the overbought level. Now, had it been we had entered a sell, we would have considered setting a stop loss above the swing high. And then, as for our exit, we can consider the nearest support level, which would have been around here, or we would have waited for price to get to the oversold before selling. So if we had before taking our profit. So if we had entered a sell trade around here and then taken our profit after price entered oversold, we would have caught about 300 pips, right? We would have caught about 300 pips from our entry to our exit. Now, as for the oversold conditions, it is when RSI is below the 30 level. When the RSI crosses below the 30 level, it signals that the asset is oversold, and traders often look for buy opportunities here in this area. Now we can see this as an example. Now when the RSI was below the 30 level, and as it began to curve upwards, we can see that the asset responded accordingly. So we could have considered entering a buy trade right after the RSI began to move up from the oversold, and then we could have considered setting our stop loss right below the swing low. And then as for our exit, we can consider the nearest resistance, which would have been around here, taking our profit around here, or we could have waited for the RSI to enter the overbought, and that would have been somewhere around here. So had it been we had entered here and sold at the resistance, we would have caught about 123 pips. But if we had entered and waited for the RSI to give us an exit signal, which is when it enters the overbought, we would have caught about 250 pips. Okay, now let us identify how to spot divergences using the RSI. Now, the bullish divergence usually occurs when the price makes a lower low while the RSI makes a higher low. So we can see now as the RSI is making a higher low. We can see this is a higher low. This was the first low. This is a higher low. And then at the same time, price is making a lower low. We can see that this was the first low and this was a lower low. Now this is called a bullish divergence. It's called a bullish divergence. This can indicate a potential reversal to the upside, and we can see that just right after this divergence, we can see that the price of the asset began to move upwards. We can see that it began to move upwards. So had it been we had entered a buy right after this bullish divergence, probably around here, we would have ridden the bull move right up till the point that the price entered the overbought. The RSI entered the overbought. We would have ridden the price all the way up to this point, and that would have given us about 250 pips. Okay, so now as for a bearish divergence is just the reverse. It occurs when the price of the asset is making a higher high. Let us look for that. Is making a higher high while the RSI makes a lower high. So let us look for bearish divergence. Okay, I think we have seen one here. As the RSI is making a lower high, we can see that at the same time the asset was making a higher high. You can see that here. This is a bearish divergence. Now these two divergences that we just identified are regular divergences. Regular divergence in the sense that the price of the asset is making lower low, while the RSI is making higher low. That is for bullish divergence, a regular bullish divergence. And then on the other hand, for the regular bearish divergence is when the price of the asset is making a higher high while the RSI is making a lower high. Now we can see that just right after the bearish divergence formed, we can see that the asset sold for a bit, sold for a while. So we could have considered entering our sell trade around here after the divergence, and then we could have sold at the nearest support level, or we would have waited for the RSI to enter the oversold. Well, that took quite a long while before it entered the oversold. However, if you are comfortable with waiting until the price enters the oversold, and that's absolutely fine. You can either use support level to exit your sell trade, or you can even use other indicators for additional confirmations, or you can wait for the RSI to enter the oversold level before you sell or before you close your sell trade. Now, as for hidden divergence, because we have regular divergence which we just identified now for the bullish and the bearish, and then we also have hidden divergence. So as for the bullish hidden divergence usually occurs when the price makes a higher low. The price makes a higher low, but the RSI makes a lower low. So when the price is making a higher low, for example here, the price is making a higher low, but the RSI is making a lower low, as we can see around here. Now this indicates a bullish hidden divergence. This suggests that the current uptrend may continue. This suggests that the current uptrend may continue, and we can see that it happened. The uptrend continued right after the bullish hidden divergence formed. The uptrend continued. So we could have, if we were already in a buy trade, we could have gotten confidence to stay in the trade longer. Or if we were yet to enter the buy trade, we could have just considered entering right after the bullish hidden divergence formed, and then we would have ridden the price all the way up to this point until the RSI entered the overbought level again, or we would have just even sold after it entered the overbought level at this point. But because this was just immediately after the hidden divergence form, we could have waited until the next time that the RSI entered the overbought, which would have been around here, and we would have caught about 1,000 pips. We have caught about 1,000 pips. Now, for a bearish hidden divergence, the bearish hidden divergence usually occurs when the price makes a lower high. It makes a lower high and the RSI makes a higher high. Now we can see that around here, price is making a lower high, but the RSI is making a higher high. As we can see here, the RSI was making a higher high for a bit, and then this indicates that the downward trend may continue. So we can see that just right after the bearish hidden divergence, we can see that the downward trend actually continued, guys. So this is how to use the RSI to spot divergences. Now you can combine the RSI with other technical indicators, of course. You can decide to use moving averages alongside the RSI. You can also decide to use support and resistance levels, support levels. You can decide to use other oscillators as well, such as the MACD or the stochastic oscillator, just for additional confirmation of your entry, your exit, your take profit, and your stop loss levels. Now, basically, that is how the RSI works. I hope you found this video insightful. Kindly like, subscribe, and hit the notification bell so that you can get updated on more videos for additional trading insights. Cheers, guys, and happy trading.